In 1609, a merchant walked into the Bank of Amsterdam, deposited 100 silver coins, and received a receipt. Simple enough. But then something unusual happened. Instead of withdrawing his coins when he needed to make a payment, he simply transferred his receipt to another merchant. That merchant accepted it as payment, not because he wanted the silver, but because the receipt itself was trustworthy. The coins stayed in the vault. The receipt circulated as money. This wasn't a revolution announced with fanfare. It was a quiet adaptation to a practical problem. Moving heavy metal coins across cities was slow and risky. Paper ledger entries were faster and safer. Within decades, these receipts were circulating throughout Amsterdam's trade network. Money had subtly changed form, from metal held in hand to credit recorded in books, and banks, almost inadvertently, had become creators of money itself. The common assumption treats banks as simple intermediaries, institutions that store deposits and lend them out, but don't fundamentally alter what money is. The historical reality is more nuanced. Banks didn't just handle money. Over centuries, through incremental innovations responding to practical needs, they gradually shaped how money itself functioned and was created. The question becomes, how did institutions meant to safeguard value end up transforming it? To understand how banks came to shape money creation, it helps to step into the worldview of medieval and early modern commerce, a world where trust was local, transactions were physical, and the concept of money was more tangible than abstract. In medieval Europe, banking emerged not from governments but from merchant activity. Italian city-states, Florence, Venice, Genoa, developed sophisticated trade networks spanning the Mediterranean. Merchants needed ways to move value across distances without transporting heavy coins or risking robbery on dangerous roads. Early banking families like the Medici in Florence operated as trusted intermediaries. They held deposits, facilitated payments between cities, and extended credit to reliable clients. Their power came not from state authority but from reputation. A merchant accepting a Medici bill of exchange trusted that it could be redeemed because the Medici name carried weight across Europe. This trust was personal and network-based. Banking relationships were inherited across generations. Defaults were rare not because of legal enforcement, which was weak and inconsistent, but because reputation loss meant exclusion from profitable trade networks. The system functioned on social capital. As trade expanded in the 16th and 17th centuries, these informal practices became more structured. The need for stable, reliable payment mechanisms grew alongside the volume of commerce. Carrying gold and silver for every transaction was impractical for large-scale trade. The risks of loss, theft, and the physical burden of transport created inefficiencies. Banks offered solutions. They could verify the purity and weight of deposited coins, reducing the need for merchants to assess each transaction independently. They could provide receipts and transfer mechanisms that moved value on paper while the physical metal stayed secure. They could extend credit during the lag between purchasing goods and selling them, lubricating the gears of commerce. The worldview that allowed this role expansion was fundamentally pragmatic. Medieval and early modern merchants didn't philosophize about the nature of money. They needed tools that worked. Banks provided those tools, and their functions expanded organically to meet demand. Importantly, this expansion wasn't viewed as creating money in the modern sense. It was seen as facilitating exchange, making existing value move more efficiently. The distinction between storing money and creating money wasn't sharp in contemporary understanding. Banks held deposits, extended credit, and issued payment instruments. These activities blurred together in practice. Governments played limited roles initially. Minting coins was a sovereign privilege, and monarchs jealously guarded it. But the daily mechanics of commerce, how merchants paid each other, how credit was extended, how value moved between cities, largely operated through private networks. Banks filled the gap between state-issued coinage and the complex needs of commercial activity. This setting created the conditions for banks to gradually, almost invisibly, take on a more fundamental role in the monetary system, not through grand design, but through accumulated practical innovations that met immediate needs. The transformation of banks from custodians to creators of money unfolded through several overlapping developments, each responding to specific commercial needs. Early credit practices and bills of exchange. The earliest form of bank-created money was the bill of exchange, which emerged in medieval Italy. A merchant in Florence needing to pay a supplier in Bruges could deposit coins with a Florentine bank and receive a letter instructing the bank's correspondent in Bruges to pay the supplier. The Bruges Bank would honor the letter, and the two banks would settle accounts periodically. These bills began to circulate independently. Instead of immediately redeeming them, merchants would endorse them to other parties as payment. A bill issued in Florence might pass through 5 or 6 hands before anyone claimed the actual silver. During its circulation, it functioned as money, accepted as payment, representing value, facilitating exchange. This was credit creation in embryonic form. The same pile of silver coins, sitting in a Florentine vault, backed multiple bills circulating simultaneously in different cities. The money supply had effectively expanded beyond the physical metal. The emergence of deposit banking. By the 17th century, deposit banking became more formalized. The Bank of Amsterdam, founded in 1609, exemplifies this development. It accepted deposits of various coins, standardized their value in bank money, which eliminated the problem of debased or foreign coinage, and allowed depositors to transfer balances via ledger entries. The innovation was subtle but profound. Instead of withdrawing coins to make payments, merchants simply instructed the bank to debit their account and credit another's. The money existed as accounting entries. Physical coins remained in the vault, but value circulated on paper and in ledgers. This created a multiplication effect. If deposits could be transferred rather than withdrawn, the bank didn't need to hold every deposited coin in reserve. Some proportion could be lent out or invested, because not all depositors would demand withdrawals simultaneously. This practice, holding fractional reserves, allowed banks to create credit beyond their actual metallic holdings. The Bank of Amsterdam was conservative in this regard, maintaining high reserve ratios, but the principle was established. Other banks, especially in England and Scotland during the 18th century, pushed the boundaries further. Scottish free banking and credit expansion. Scotland in the 18th century developed a relatively unregulated banking system where multiple banks issued their own notes. These notes were promises to pay specific amounts of gold or silver on demand. They circulated as currency, accepted throughout Scotland and even into England. Scottish banks discovered they could issue more notes than they held in metal reserves, as long as public confidence remained strong. If only a small fraction of notes were redeemed at any given time, banks could lend aggressively, earning interest on loans while the notes circulated as money. This was fractional reserve banking in practice. The money supply expanded as banks made loans. When a bank lent £1,000 by issuing notes, those notes entered circulation and functioned as money, even though they were backed by only a fraction of actual metal reserves. The system worked remarkably well for decades. Banks competed for reputation and prudence. Overissuing notes risked bank runs if confidence faltered, so market discipline constrained behavior. The Scottish economy experienced significant growth, facilitated by this flexible credit system. The rise of central banking. Bank of England, chartered in 1694, represented a different model. It was established as a private institution but with close ties to the government. Its initial purpose was to lend money to the Crown, but it gradually took on broader functions, holding deposits for other banks, managing the government's accounts, and eventually acting as lender of last resort during financial panics. The relationship between the Bank of England and the government created a new dynamic. The bank could expand its note issue to fund government borrowing, effectively creating money to finance state expenses. This was more controlled and centralized than Scottish free banking, but it had similar effects, expanding the money supply beyond physical metal reserves through credit creation. By the 19th century, central banks across Europe and North America played crucial roles in managing money supplies. They didn't replace commercial banks but regulated them, set reserve requirements, and provided liquidity during crises. The layered structure, central bank at the top, commercial banks below, became standard architecture. Unintended consequence, flexibility and complexity. The cumulative effect of these developments was increased flexibility in the money supply. Economies were no longer constrained by the physical availability of gold and silver. Credit could expand to meet commercial needs during growth periods and contract during downturns, though this contraction often happened suddenly, creating instability. But flexibility came with complexity. Money was no longer just the coins in circulation. It included bank deposits, notes, bills of exchange, and various credit instruments. The line between money and credit blurred. This created new possibilities but also new vulnerabilities. Bank runs became a recurring phenomenon. If depositors lost confidence and demanded their money simultaneously, fractional reserve banks couldn't honor all claims. Failures in one bank could trigger panic, spreading to others. The system's efficiency depended on sustained trust, a fragile foundation. Central banks emerged partly to manage this fragility. By acting as lenders of last resort, they could provide liquidity during panics, preventing cascading failures. But this also meant centralizing power and responsibility, creating institutions that could stabilize or destabilize entire economies through their decisions. None of this was planned comprehensively. Each development responded to immediate needs, facilitating trade, expanding credit, managing crises. The aggregate outcome was a financial system where banks, through routine lending operations, created most of the money supply. The coins and paper currency issued by governments were a small fraction of total money, most of which existed as bank-created credit entries. This transformation was quiet because it was gradual and technical. Most people continued to experience money as physical currency, unaware that the larger structure had fundamentally changed. The evolution of banking reveals patterns that extend beyond the specific historical contexts, patterns about how intermediaries evolve within economic systems. Intermediaries enabling growth. The first pattern is that trusted intermediaries enable expansion beyond what would be possible through direct exchange alone. Medieval merchants could trade across Europe because banks provided reliable payment mechanisms. 18th century Scottish businesses could invest and grow because banks extended credit flexibly. Intermediaries reduced transaction costs, the friction involved in verifying, transporting, and exchanging value. By consolidating trust in institutions rather than requiring it between every pair of trading partners, banks allowed commerce to scale. A merchant didn't need to trust every buyer personally. Trusting the bank that facilitated payment was sufficient. This pattern appears throughout economic history. Stock exchanges, insurance companies, credit rating agencies, all are intermediaries that enable activities too complex or risky for direct person-to-person arrangements. Banks were early examples of this principle. Trust and expansion in tension. A second pattern involves the balance between trust and expansion. Banking systems function well when trust is high, but the pursuit of expansion can undermine that trust. Scottish free banking worked when banks competed for reputation and customers could easily distinguish sound banks from reckless ones. When information was clear and failures penalized quickly, market discipline maintained stability. But as systems grew more complex and interconnected, this discipline weakened. A failure in one institution could trigger cascades that overwhelmed even prudent banks. This tension is structural. Growth requires extending credit, which means creating money through lending. But excessive credit creation erodes confidence. The boundary between healthy growth and unsustainable excess is unclear in real time. Participants must judge whether expansion reflects genuine economic opportunity or speculative bubbles. Central banks emerged partly to manage this tension, but they also altered it. By providing backstop liquidity, they reduced the immediate penalty for overexpansion, potentially encouraging riskier behavior, a dynamic later formalized as moral hazard. Gradual shifts in perception. A third pattern is the slow evolution in how money itself was understood. Initially, money meant physical commodities, gold, silver, stamped by authorities. Banking practices gradually transformed it into abstract credit relationships recorded in ledgers and represented by paper instruments. This shift didn't happen through philosophical debate or legal decree. It emerged from accumulated practice. Merchants accepted bills of exchange because they worked. Depositors used bank transfers because they were convenient. Borrowers used banknotes because they were accepted as payment. Over time, practice shaped perception. Money came to be understood less as a thing with intrinsic value and more as a claim or credit within a system of relationships. This conceptual shift had profound implications, enabling fiat currency and modern monetary policy, but it occurred almost invisibly. Layered complexity. A fourth pattern is increasing layering and abstraction. Early banking was relatively simple, holding deposits, facilitating transfers, and extending some credit. Over centuries, layers accumulated. Commercial banks, central banks, interbank markets, clearinghouses, regulatory frameworks. Each layer added functionality but also complexity. The system became more capable, able to handle larger volumes, coordinate across greater distances, and respond to varied needs. But understanding the whole system became harder. Most participants understood their immediate layer, but not the broader architecture. This layering is typical of evolving institutions. Simple structures become complex through accretion. Complexity enables sophistication but obscures transparency. The trade-off is persistent across domains, legal systems, bureaucracies, technologies, all tend toward layered complexity over time. The patterns visible in early banking's evolution echo in later financial developments, though the forms change with technology and scale. The 19th century saw the expansion of savings banks and building societies, institutions that mobilized small deposits from working-class savers and channeled them into mortgages and local lending. These followed the familiar pattern, intermediaries enabling credit expansion by pooling resources and spreading risk. The social composition differed from merchant banking, but the functional logic remained consistent. The early 20th century brought investment banks and corporate finance to prominence. These institutions intermediated between savers and industrial enterprises, facilitating capital-intensive development, railroads, factories, utilities. Again, the role was intermediation enabling growth, creating complex instruments, bonds, stocks that represented claims on future value. The layering continued. Later decades saw the rise of shadow banking, money market funds, securitization vehicles, repo markets, performing bank-like functions outside traditional regulatory frameworks. These echoed the early tension between innovation and stability. They expanded credit availability and financial flexibility, but introduced new fragilities, as became evident during periodic crises. Digital payment systems and cryptocurrencies represent recent iterations of the ancient pattern, seeking more efficient ways to transfer value, reduce transaction costs, and expand the functional definition of money. Whether these ultimately integrate into or disrupt existing banking structures, they reflect the same underlying dynamic, intermediaries evolving to meet perceived needs, with consequences that unfold gradually. Throughout, the core observation holds. Institutions that begin as passive facilitators often evolve into active shapers of the systems they operate within. Banks were meant to safeguard money. They ended up creating it. The transformation was neither planned nor accidental. It was emergent, arising from the accumulated logic of practical problem-solving within particular constraints. The echoes across time suggest this isn't unique to banking. Any intermediary institution, platforms, networks, regulatory bodies, faces similar evolutionary pressures. Functions expand to meet demand. Complexity accumulates. The line between facilitation and creation blurs. The question posed at the beginning, how did institutions meant to safeguard value end up transforming it, has an answer visible across centuries of banking evolution. Banks became creators of money not through deliberate design or sudden innovation, but through incremental adaptations to practical problems. Each step made sense in context. Issue receipts to ease transport, allow transfers to speed payment, hold fractional reserves to expand credit. Individually, these were modest innovations. Cumulatively, they reshaped the architecture of money itself. The transformation was quiet because it occurred within the ordinary workings of commerce. Merchants didn't experience a revolution. They simply used the tools available, bills, deposits, notes, and those tools gradually changed what money meant and how it functioned. This history reveals banks as quiet shapers of value flow, institutions whose routine operations determined not just who accessed capital, but how much capital existed. The role expanded incrementally, largely invisibly, embedding itself so deeply into economic systems that separating bank from money became conceptually difficult. The quiet role of banks has long influenced how value moves, not through dramatic interventions, but through the accumulated weight of everyday adaptations that over time became foundational structures. Understanding this requires looking past the surface mechanics of deposits and loans to the systemic patterns beneath, patterns of trust, intermediation, and emergent complexity that shape economies across eras. If this perspective shifted how banking appears, not as simple storage, but as quiet architecture shaping money itself, there are related questions worth exploring. How do modern regulatory frameworks attempt to manage this creative role? What does digital currency reveal about the persistent patterns? The history offers more depth than most contemporary discussions acknowledge. Thank you for your attention. These patterns reward careful observation.